no one's all in. No one's like, it's going to keep going, or actually there's quite a level of conservatism. There is risk, obviously, with all this tariff and stimulus coming through, that we're going to go through another period of heightened inflation. I think that's a real risk. Depending on what part of the Australian market you look at, we're up sort of 20 to 40%. So everyone that's thinking, oh, I can't keep going and it's done so well, it's done so well since the absolute lows of April, but it's still quite early cycle.
Hi, welcome to Shared Lunch, brought to you by Sharesies. I'm Jackie Newman, Head of Capital Markets at Sharesies. Today, we're welcoming back Michelle Lopez, Head of Australasian Equities and Portfolio Manager at Pi Funds.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Before we get started, I want to acknowledge the Gadigal people of the Eora Nation, the traditional custodians of the land, water and sky from where we're filming today, and pay respects to elders past and present. Hi Michelle, great to have you back with us. Thank you for joining. Last time we had you on, the Liberation Day tariffs had just been announced and markets were quite volatile. Fair to say that there is still some noise around tariffs and uncertainty persists, but by and large it feels like volatility has somewhat abated, and indeed we've seen markets rally in the last few months. Looking at it through your expert lens, how would you characterise global equity market conditions at the moment?
Buoyant still, but it's quite incredible. Looking back on the last 6 months, the market's kind of been linear since and on an upward trajectory, and a lot of the indices, the S&P 500 being the main one globally, US-based, it's been quite a narrow still performance period. So by narrow, I mean a select few type of companies, very much those leveraged to AI. The big tech companies, Magnificent Seven that everyone keeps talking about, they're still driving the rally. When we sort of think about conditions, what's really sort of propelled that is obviously a lot of the political side of things. We've got a bit more line of sight around tariffs. There is policy changes happening on a daily basis though. So there are certain sectors that are being affected more than others. Healthcare is a sector in the US and globally, in fact, because it is a global sector that is still sort of finding its way through new tariff announcements. So I certainly don't think that it's all kind of clear and green light ahead, but as we've seen in industry performances and specific companies, it has been a really buoyant time to be in the market over the last 6 months. The other thing I'd say, though, it's not a uniform kind of positive sentiment out there. In fact, when I speak to a lot of my peers and a lot of my colleagues, no one's all in. No one's like, this is, it's going to keep going, or actually there's quite a level of conservatism that I'm seeing and I'm hearing, and I have it and I share that level of conservatism myself. And there's a few factors driving that. We're also starting to see, revisions to the employment market, so that unemployment number in the US specifically being revised upwards. More recently, we've had, unemployment tick up in Australia as well to 4.5%. A lot of capital has come into our market, and, stepping outside of the equity market, you've got, private credit, which has seen a huge influx. There's crypto, and everything feels like it's going up at the moment, but the sentiment, I think, is quite bifurcated. You got some concerns, and then you've got some people that are more thematic driven. AI, anything that has AI connected to it in some way seems to be doing really well.
So if we take a closer look at the Australian market, how would you say that it looks relative to other offshore markets at the moment? And I guess what I'm saying is, would you say that now is a good time to be more or less invested in local stocks?
Our market's quite different to the global market, and I'm saying global, a lot of it is very much still US driven, in the sense that AI and tech is a very big part of that market. We don't have that in Australia or New Zealand. In fact, when you look at the large cap part of the market, it's, the big four banks. We've got some supermarkets. We've had, some healthcare names in there as well, Wesfarmers. So very different drivers. That part of the market has done exceptionally well over the last 4 years. And in fact, what we've seen more recently over the last 3 months, call it 6 months, is large caps and those big blue chip companies in Australia probably not do so well. At the other end, which is small caps, it's a much, much broader composition within that part of the market. And what's driven small caps over the last 12 months, and I'll probably drill it down to 3 things. It's commodities, specifically gold. It's anything kind of defence related, and technology as well. And we're starting to see, again, the underperformance that we've had in small caps over the last 4 years start to unwind a bit and catch up. You ask, is it a good time? It is, because it's broadening out. So I said that the global rally has been very much driven by these larger companies, tech, AI, all of that. We're starting to see that broaden out in Australia. And what's driving that is economic conditions, interest rates. So as New Zealand, as most of the developed world actually is cutting rates, we're in that cycle too. And what that effectively means is you've got a lot more sort of macro support and economic support and stimulus coming through. So I think it is an interesting time, depending on what part of the Australian market you look at. We're up sort of 20 to 40% from the lows in April. But on a yearly basis, on a 12-month basis, the large cap is up maybe 8%, and sort of the small cap is maybe up 18%. So it's not euphoric in any way. So everyone that's thinking, I can't keep going and it's done so well. Well, it's done so well since the absolute lows of April, but it's still quite early cycle.
So do you feel as though there is a likelihood that small caps will continue this outperformance? What's your sense on how that will play out in the next 12 months or so, just looking at the economic picture and other factors?
Yeah, I do. I do think it will continue. But let me tell you why, because I think sort of the reasoning is probably more important. What drives small caps? And if I sort of outlined those kind of macro settings, so you've got interest rates coming down. Why is that a positive for small caps? Well, 3 reasons. Firstly, cost of debt is cheaper. A lot of these small caps rely on debt funding to grow, so either capital expenditures or M&A or whatever the case may be for capital allocation. It's gotten cheaper. And typically the term on the debt is shorter because banks are not willing to lend out 5-10 years for more sort of riskier assets or companies. So they're refinancing at much lower rates, and that directly falls through to the bottom line from an earnings perspective. The second thing is the consumer. So the consumer underpins small caps in a big way. As you would know, if your interest rate on your mortgage is going down, then you've got a lot more discretionary spend. So it kind of goes across the board. And then thirdly, valuations. So a way to value a company is discounting its earnings back to the present. So future earnings back to the present. The discount rate that you use is tied to cash rates. So effectively, there's a direct correlation, indirect correlation, lower rates, high valuations. So they're the 3 things, and why that affects small caps more and positively impacts small caps more than large caps. So we have a rate cutting cycle. The other thing I'd say, and I came back to small caps being a much broader reflection of our economy. Commodities is a big part of that index, so it's probably worth touching on that separately. But you've got everything from consumer stocks, discretionary, you've got contractors, you have healthcare, you have tech, and it's a real, property, and it's just a much more balanced view. So when we're in constructive economic backdrop like we are now, you've got fiscal stimulus, you've got monetary policy easing, and yes, unemployment I mentioned is ticking up a little bit, but it's still very supportive. And that all plays into sort of a positive outlook for small caps, I'd say more so than large. I think over the next 12 months, longer out, it is cyclical part of the market, so it's not forever. But I think for the next 12 months to frame the timing there's still scope to continue the outperformance.
I guess if we could zoom in on some of those sectors that you mentioned around and the themes around lower interest rates and a more positive consumer. Firstly, around interest rates, are there any particular sort of subsectors or stocks even that you're focused on that you think are sort of leveraged to this lower rate environment that we're in, and with rates expected to go even lower?
As a house, PI Funds really does look at companies on a case-by-case basis. So we are very much fundamental bottom-up investors, and it's all about the company. Having said that, though, we wouldn't be doing our job properly if we didn't recognise the industry that they're participating in, and it's a very big part of the assessment that we undertake of the company. So there are absolutely industries or sectors that benefit more. A very simple one to understand is property. So we've had a lot of our REITs trading at very steep discounts to their NTA, their net tangible assets, so the property backing. So anywhere between 20 all the way down to 50% discounts. So what a rate cutting cycle implies is obviously you're able to take out debt to actually drive growth within sort of the property sector. And obviously, as I mentioned before, the debt that you do becomes cheaper. So you have earnings accretion come through. So that's a very, very easy one to understand. But then there's second order effects of it. So you've got the consumer discretionary. That's a part of the market where we've got more money in our pockets, we can go out, we can spend more. And how that filters through is across multiple sort of sectors, but, retailers. At the August reporting season that just passed, retailers had a really good period, and we've started to see retailers post positive same-store sales growth or like-for-like growth in their revenue, in their sales. So that's a direct indication. And in fact, we were starting to see our retailers that had operations in New Zealand post really positive numbers. So anywhere between sort of 15 to 30% growth. I don't want to get overly excited because these aren't kind of the incumbents in the New Zealand market. It's, your JB Hi-Fi's, ARB, Nick Scali. They are sort of cracking that market and probably the growth. But they were going backwards not that long ago. So we did start to see green shoots in our retailers, and I think that they are very rate sensitive.
Are there any other consumer subsectors, whether it be travel or retail, specialty retail, or anything like that? Any subsectors that are piquing your interest?
Travel's tricky because travel's global, and we've had a lot of disruption across kind of global channels. And when I look at the travel sector for us, there's the leisure, and then you've got your corporate travel. And the corporate side, with all the geopolitical uncertainty that we've had, has really come off. Leisure, not so much, but it's still not as exuberant as it has been probably over the last 12, 24 months, right? So I think that's a trickier part, and there's lots of moving parts to that. So I think travel looks interesting from a valuation perspective. A number of our listed travel names are starting to screen quite attractively, and I think it's a part of the market we're doing work on. Retail, even within retail, you've got different categories. So electronics, we're going through a big replacement cycle. COVID 4 years ago, probably a lot of people bought a laptop to work from home, whatever it is, and that replacement cycle is kicking in. Windows 10, I think, are no longer rolling out or servicing that application. So again, another reason to go out and buy. Then we've got things that are leveraged to property. Property has been interesting in Australia. I know it's been very tricky and challenged in New Zealand. We actually held up really well up until about 12 months ago, and then it's just kind of flatlined. It's probably down a little bit, but not kind of the 20% moves, 30% that we've seen in New Zealand. But we're starting to see a bit of recovery in that space too. So that filters down to, your homewares, furniture. So yeah, they're the parts that I'd say I think at this point in the cycle should continue to do well.
And if we think about resources, the resources sector makes up a large component of the Small Ords Index, and we've seen gold rally significantly this year. If we look at that subsector, are there any opportunities that you're looking at in terms of gold stocks or commodities more generally? Where are you sort of focused on at the moment?
Gold has been exceptional. And, the interesting thing about gold is it's typically thought of as a safe haven. And the constructive backdrop for gold is, weaker dollar, lower interest rates and uncertainty, geopolitical uncertainty. And that's all sort of played out. But it's gone well and above and beyond, I think, what the fundamental constructive backdrop is, which may indicate a couple of things. People are genuinely worried, and that safe haven status continues. Inflation. So inflation risk, gold is seen as a hedge for inflation. So even though it's sort of down into ranges where central banks wanted to get them down to, there is risk, obviously, with all this tariff and stimulus coming through, that we're going to go through another period of heightened inflation. I think that's a real risk. So there's people buying on sort of fundamentals, but then you've started to see a bit of euphoric activity. And it's interesting, Martin Place just here in town, I'm sure you've seen sort of the pictures, there's like lines out the door. Is it a bubble? I don't think so. Can it correct 20-30%? I think so. So bringing it back to the markets, the gold price itself, I think I'll have to check this. I didn't check it before I came in, but I think the gold price is up something like 50%. Gold equities are up 100% over the last year. And what we've seen within that, and that's typical, there's leverage, there's operating leverage, there's financial leverage. And in fact, the ones that have done best are your poorer quality ones that, high cash costs to operate, which means that the leverage that they get from a higher gold price is more than sort of your good quality operators. But you've done well owning anything gold related over this period. Other commodities, I think I spoke about rare earths 6 months ago. That's had an exceptional run. That's been quite politically driven as well. The price itself hasn't moved too much. So that's a situation that we're cautious on because, again, it's a critical metal. It's strategically important for a number of these industries that are in big sort of growth trajectory. But when the fundamental commodity price doesn't move, it can easily sort of whip back down. So we're quite careful and mindful of that. Lithium is still quite challenged. We had sort of, a big, a little sort of run up 50%, but that's kind of plateaued out. And that you have to bring it back to supply and demand dynamics in a lot of those markets. But yes, you can't avoid it. And unfortunately, being underweight that part of the market for us, we've done, it's proudly done quite well to be able to sort of hold the performance and deliver exceptional performance without owning lots of those companies that have run a lot.
I want to talk about AI. It's very topical, in the media at the moment. Would you say that there are ways to play that thematic more indirectly across our markets?
There's certainly companies in the AI space. It's just not the concentrated nature in the large caps that we see offshore. The very obvious one is data centres. So there is certainly small cap all the way through to large cap in Goodman Group, who have now become one of the largest DC operators or developers, sorry. So you've got, even in New Zealand, Infratil and 50% stake in thereabouts, stake in CDC. CDC are an exceptional operator of data centres, and you've got NextDC as a mid-cap in Australia. Then you've got Macquarie Telecom, sort of small cap. So that's kind of a very direct way of playing it. There is a massive amount of capital going into data centres at the moment. And even just yesterday, CDC announced another 40 megawatt contract the week before they announced 100, or the week before that, 100 megawatt contract. So there is absolutely no shortage of demand from that. And it seems that there's no shortage of capital that wants to be invested in this space as well. So at the moment, there is clearly more demand than there is supply by far. But at some point that will sort of even out. I'm not expecting that, at least for the next 3 years, but at some point that will happen. And the one thing I would note as a signal to maybe pull back a little bit is when you start to hear your big hyperscalers, your Amazon, your Google, cutting back on their CapEx on AI, that's quite a negative signal. Coming back to kind of opportunities, so you've got the data centers, then you've got a lot of these companies that are internally generating products that are AI enabled, or to help their customers and clients be more efficient. Here Xero is a typical, they've got agentic AI module for their accountants using the software. You've got WiseTech that are coming out, which is a logistics company. And then more in the small and micro cap, you've got Life360 that are using sort of AI as well with their application of tracking their tracking software. So it goes the whole way through. So you can absolutely get access to it. It's just more not those hyperscalers that we have here that we can invest in. But there's certainly ways, and I would be shocked if 50% of the companies that we are invested in don't have some form of AI now embedded into their workflows.
A good barometer for institutional investor confidence in the outlook for markets are the cash balances that they hold. Last time we spoke to you, you mentioned that across some of the PI funds you were at or close to mandate limits in terms of those cash balances, just given some caution around markets. How would you say that has changed in the last 6 months? Would you say that you've got a lot of dry powder or cash on the sidelines still? How fully invested are you?
Yeah, we're very fortunate that our mandate allows us to move as much into cash as we would like to, depending on how we see the environment. What we have, though, are internal ranges that we like to operate in, but those ranges change. So if sort of post-COVID, that range went up to 50%, so we could own up to 50%. Back in April, we increased the range from, I believe it was 5 to 15%, and we're sort of sitting at that higher end. That range still holds today, but we're probably more towards the mid to bottom end. We were very fortunate that we're able to allocate and take up some opportunities in the market. Now, typically speaking, we are taking a bit of profit in those names that are up 30, 40%. But we're seeing lots of opportunities. We're genuinely seeing lots of opportunities. Coming out of reporting season in August, we didn't touch on the contractors, but there's anything leveraged to infrastructure. Infrastructure isn't just kind of building roads and tunnels and that. It's electricity grid and this whole electrification, and talking about data centres, for example, the need of energy for those centres to be built. There's been a massive investment in transmission that's required. So that's what I mean sort of by infrastructure. The contractors, whether it's, gold mining, whether it's replacement ores in iron ore, whether it's oil and gas, we are seeing really strong pipelines within that space. So we are genuinely seeing a lot of opportunities. So to your question around cash ranges, we're probably sitting around kind of the mid range to the lower of that cash range, depending on the funds, because we genuinely see quite a lot of opportunities at the moment.
Thank you, Michelle, for being on this episode of Shared Lunch. It's been great to have you on.
No, it's a pleasure. Always happy to be here.